Something strange happens when you look closely at the gold and silver crash of January 29th, 2026. I mean, if you were just watching the tickers on your phone screen that morning, it looked like a total disaster.
A complete bloodbath.
Right, a complete bloodbath. But when you actually dig into the trade data, the time-stamped order flow, the picture changes.
It changes completely. It goes from a chaotic accident into something that looks, well, suspicious.
Suspicious, yeah, almost engineered.
And that's exactly the angle we're exploring today.
We are unpacking a source that breaks down the anatomy of what they're calling the 60-minute wipeout. And look, I don't want to gloss over the damage here.
Oh, no?
We are talking about staggering numbers. According to the data, $6 trillion of market value evaporated in less than an hour. To put that in perspective for you, gold fell from an all-time high of $5,600 down to $5,100.
That's a $500 drop.
And silver went from 121 to 108.
And the speed is the really terrifying part. This wasn't a slow bleed over a bad month, where you have time to adjust.
Right, you can react.
This happened in the time it takes to brew a pot of coffee. You could have walked away from your screen to grab a snack, come back, and found your portfolio just decimated.
So the source we're diving into today makes a claim that, frankly, sounds a little conspiratorial at first glance.
It does.
They argue this wasn't bad luck, it wasn't a mine collapse, or some new discovery of ore. They're calling it a robbery in broad daylight.
Or, more technically, a bear trap set by the biggest institutional players.
And it sounds like a conspiracy, you're right, until you see the charts. Then it just looks like, well, market mechanics.
Terrifying mechanics for the little guy.
Yeah.
But if you understand how the trap works, it's actually a roadmap for what happens next.
Before we go further, make sure to hit subscribe and support us.
So let's get into those mechanics.
Okay, help me understand this. Because $6 trillion doesn't just vanish into thin air. Where? Where does the money actually go?
It doesn't disappear. It transfers. And to get this, you have to understand a concept called a liquidation cascade.
A cascade.
Yeah, the source uses a domino analogy, but I think it's better to think of it like someone yelling fire
Yeah.
in a crowded theater.
Okay, set the scene.
Yeah. So imagine you've got thousands of traders who are leveraged. This means they're not just buying gold with their own cash.
They're borrowing.
They're borrowing money to buy 10, maybe 20 times more gold than they can actually afford, because they are so sure the price is just going straight up.
They're betting the farm using the bank's money.
Exactly. But here's the math that kills them. If you are leveraged 10 to 1 and the price of gold drops just 5%.
Wait, if I have 10 times leverage, a 5% drop means I lose 50% of my money.
Actually, in many cases, you lose everything because the broker has this safety switch. It triggers a margin call. An algorithm just wakes up and says, hey, this trader doesn't have enough cash to cover this loss anymore. So the broker automatically sells their gold. They don't ask permission. They just dump it on the market.
And if there are thousands of these traders getting sold out at the same time.
That selling drives the price down further, which then triggers the margin call for the next person, who was maybe leveraged 8 to 1.
And her gold gets sold.
Which pushes the price down again, and it hits the next group. It's a waterfall. It's not human beings making decisions anymore. It's just algorithms all trying to exit a burning building at once.
So when the source says this was engineered, are they saying someone lit the match on purpose? Because that sounds illegal.
Engineered might be a strong word, but anticipated is probably dead on.
Okay.
The smart money, the big hedge funds, they have data feeds that show where all these leverage lines are. They know exactly where the weak points are.
So they know that if they can just push the price down enough to knock over that first domino,
so gravity will do the rest of the work for them.
they just give it a little nudge.
A nudge. They sell hard, they trigger the cascade, they wait for the panic to wipe out all the little guys, and here's the key. They are waiting at the bottom to buy back those same assets for pennies on the dollar.
So while retail investors are panic selling because they see this giant red candle on the screen, the institutions are treating it like a Black Friday sale.
Exactly. They are literally scooping up the panic.
That is diabolical, but it makes perfect mechanical sense. But something here still confuses me.
What's that?
The source says the metal itself didn't change. Gold is still gold. So if I'm holding it as a safe haven, a hedge against chaos, why does it crash during a panic? Shouldn't gold be the one thing that holds steady?
In a perfect world, yes. But in the trading world, no. You have to look at the invisible force that drives these prices. And that's the DXY.
A dollar index.
Right. If you want to understand gold, you usually have to stop looking at the gold chart and start looking at the dollar.
Okay.
The source uses a seesaw analogy that's really helpful here.
Walk us through that.
Picture a playground seesaw. On one side, you have the US dollar, the DXY. On the other, you have commodities like gold and silver.
And they're basically fighting each other.
They are mortal enemies. They're fighting for the same capital. So it's almost a law of financial gravity.
If one goes up, the other has to come down.
It has to. And most trading algorithms are programmed with a very simple rule. If the DXY spikes green, sell gold immediately.
And on January 29th, the dollar didn't just go up.
It spiked hard.
So what this really means is the floor everyone was standing on, the currency itself, shot upward.
Which makes everything priced in that currency look like it's falling. The source emphasizes that professional traders, the guys with the multi-million-dollar bonuses, they aren't just staring at the gold chart.
They're staring at the DXY.
It's their crystal ball for metal prices.
Okay, so the dollar spiked, the seesaw slammed down, but why? What caused the dollar to flex its muscles so suddenly on that specific morning? Currencies usually move so slowly.
The source points to 3 specific triggers that all hit at once. The first one was the Federal Reserve.
The Fed, it always comes back to the Fed, doesn't it?
It almost always does. The Fed controls the money printer. And on that morning, the Fed sent what we call hawkish signals.
Okay, let's define that for anyone who doesn't speak central bank. We hear hawkish and dovish all the time.
Right. Think of a hawk as a bird of prey. It's aggressive. So in Fed speak, it means they want to keep interest rates high to fight inflation.
And dovish is the opposite.
Dovish is being nice, cutting rates. The market was hoping for a dove, but it got a hawk.
But hold on. Why does a hawkish Fed so high interest rates make the dollar spike? Wouldn't high rates be bad for the economy?
It can be tough for borrowers, sure, but for currency traders, high rates are like a giant magnet.
How so?
It's the carry trade logic. Think of the US dollar like a savings account. If the US is paying 5% interest, but Europe or Japan is only paying, say, 1%.
I'm moving my money to the US bank.
Instantly, investors sell euros, sell yen, and they buy dollars to get that higher yield. That massive wave of buying is what drives the DXY up.
And as we know from the seesaw.
When DXY goes up, gold gets crushed. That was trigger number 1.
Okay, but I noticed something in the report about silver. It crashed even harder than gold, something like 11% versus 9%.
Right, and that brings us to trigger number 2, China.
Now think about this. Why would China affect silver so much more than gold?
This is where you have to understand the split personality of silver. Gold is simple. It's money. It sits in a vault. It looks pretty.
And that's its job.
That's its job.
That's it.
But silver is money plus a machine part. It's an industrial ingredient.
Right, it's in solar panels, iPhones, EVs, all the AI data centers.
It has a job to do. And China is the factory of the world. They make the solar panels, they make the chips. So on the morning of the crash, some really ugly factory data came out of China showing a huge slowdown.
The logic being, if China's factories are stalling, they don't need silver to build things.
Precisely. The source puts it perfectly. If China sneezes, silver catches a cold. Gold doesn't care as much about factories, so it held up a little better. But silver got hit with a double whammy, the strong dollar from one side and weak industrial demand from the other.
That explains the extra volatility. But there was a third trigger, right? Something more political.
Yes, the political excuse, which was the looming U.S. government shutdown. The deadline was January 31st.
Ah, right, the shutdown drama. But we see those all the time. It's usually just political theater, isn't it? Does the market really care?
It is theater, but markets hate uncertainty more than they hate bad news.
Good point.
So even if everyone knew it would probably get resolved, that uncertainty gave investors an excuse. And you have to remember, gold had just rallied 30% and silver was up 65%. People were sitting on massive profits.
They were just looking for a reason to sell and lock it in.
Exactly. The shutdown fear was just the snowflake that started the avalanche. It gave everyone a logical reason to cash out, which just fueled that cascade we talked about.
So you have the Fed pumping the dollar, China slowing down industrial demand, and Washington creating political fear. It really was a perfect storm.
A perfect storm designed to wipe out the leverage.
If this perspective feels useful, take a second to subscribe. It genuinely pushes me to keep bringing more research stories.
Moving on, there's a nuance in the relationship between gold and silver that the source really hammers home. And honestly, this part is easy to miss, but it changes everything.
You're talking about the speedboat analogy.
I am, yeah. A lot of people treat gold and silver like they're twins. They think they move at the same speed. They don't.
Not at all.
Gold is like a massive cruise ship. It turns slowly, it's steady, it can handle rough waters without spilling the champagne.
And silver.
Silver is a speedboat with a Ferrari engine.
Gold on steroids.
Exactly. The source calls it the multiplier. When gold moves, say, 5%, silver tends to move 10 or 12%.
Which is fantastic when the price is going up. Everyone loves a Ferrari on the highway.
It creates incredible wealth on the way up, yes. But gravity works both ways. It wipes people out twice as fast on the way down.
And that's why we saw silver drop 11%, while gold only dropped 9%.
That extra volatility is the price of admission for trading silver.
So if you can't handle the speedboat chopping through the waves and slamming you into your seat, you should probably stay on the cruise ship.
Or at least understand that you're going to get wet. You can't leverage the speedboat the same way you leverage the cruise ship.
Now, despite all this carnage, the trillions lost, the panic, the source, seems surprisingly optimistic. They actually point out a pattern, a sense of déjà vu.
They do. They compare this January 29th crash to what happened in late December 2025, just a month before.
What happened then? Because I remember everyone screaming that the bull market was over back then, too.
It was very similar. Late December, specifically the 30th and 31st, saw a sharp, violent crash. Sentiment was in the toilet. Everyone thought the top was in. And then what happened?
January exploded.
Immediately. January saw one of the biggest rallies in decades. And the argument here is that this crash, it serves a biological function for the market. It shakes out the tourists.
The people just chasing the hype.
Right. And it cleans out all that dangerous leverage. It basically resets the market for the next leg up.
So the crash is actually fuel.
In a bull market, yes. Fear is fuel. And the source points out a key stat here. The fundamentals haven't changed.
Explain what that means. What fundamentals specifically?
Well, you look at the big players. Tether is still buying 1 to 2 tons of gold every single week to back their stablecoin. The BRICS nations, Brazil, Russia, India, China, they are still stacking physical bars to de-dollarize.
And the silver shortage for solar panels is still a problem.
It hasn't been solved, so the physical demand is still there. It's just the paper sentiment that shifted for a moment. The price tag changed, but the actual value didn't.
And the big players know this.
Of course. They used the crash to buy more physical metal while the paper traders were selling.
Okay, so if this is just a temporary setback, when does the pain end? The source actually gave a specific prediction, which I found surprisingly bold.
They did. And usually, analysts are vague. They say soon or eventually. This source is forecasting a specific bounce back. Specifically, they believe silver will be back above $120 by February 15, 2026.
February 15th. That is a very tight window. What is the logic behind that specific date?
It's about the supply chain. Their reasoning is that the $13 discount dropping from $121 to $108 is simply too good for industrial buyers to ignore.
The solar companies, the tech giants.
Exactly. They need this metal to keep their factories running. There aren't trading charts. They're buying raw materials. They've been waiting for a dip, and they just got a big one.
And by February 15th, the government shutdown drama should be over, one way or another.
Right. The uncertainty clears, the industrial buyers return, and the price snaps back like a rubber band.
That's the theory. The deeper the pullback, the harder the snapback.
It is.
So what does this all mean for someone listening? The source breaks down a playbook for 3 specific types of people. I want to go through these because they seem very practical.
Yeah, and they're quite cautious with this advice, actually. It's not just buy the dip. It's divided based on who you are.
Let's start with the first group, the physical holders. People with coins in a safe or bars in a vault. What's the advice?
Do nothing.
Nothing. Just watch the value drop.
Absolutely nothing. Physical metal is insurance. It's long-term wealth preservation. You don't lose ounces just because the screen shows a lower price today than it did yesterday. You still have the same amount of metal.
It's not a loss until you sell.
Exactly. If you sell now, you're just locking in a loss based on temporary fear.
Okay, that's reassuring. It's about the long game. What about the second group? The leverage traders, the ones betting with borrowed money.
The source is brutal here. They call leverage a death sentence in this kind of volatility. If you are borrowing money to bet, the advice is to cut it. Now, volatility kills leverage. As we saw with the cascade, the system is literally designed to hunt you.
You risk total annihilation of your account.
You do. Don't try to outsmart the algorithm.
Okay, clear warning there. Don't pick up pennies in front of a steamroller. And finally, the third group, the cash buyers. People sitting on the sidelines with cash.
For them, this is the opportunity. The advice is to buy the fear, buy the blood in the streets. When everyone else is panicking, that is when the real wealth transfer happens.
But, and this is a big but, they advise buying in tranches.
Right. Do not throw all your money in at once.
Why not? If you think it's a bottom, shouldn't you just go all in?
Because you never know if it's the absolute bottom. It could drop further. The source suggests buying a little bit now. If it drops another $5, buy a little more. Average your way in.
So you're not trying to be a hero.
Don't try to catch a falling knife with your entire life savings.
That feels much more rational. It stops being about gambling on the perfect price and starts being about accumulation.
That's the key takeaway. And it brings us back to the core philosophy of this whole deep dive. The source ends with a thought that really stuck with me.
About the nature of the market itself.
Yes. They describe the market as a machine. And its job isn't just to set prices. Its primary job is to transfer money.
From the impatient to the patient.
From the emotional to the rational.
From scared to the prepared.
That's $6 trillion.
Yeah.
It didn't just burn up in a fire.
No, it just changed addresses.
It moved from the pockets of the people who panicked to the pockets of the people who had a plan.
That is a powerful way to look at it. It stops being about the red candles on the chart and starts being about your own psychology. Are you the person panicking or are you the person waiting?
Exactly. The market is just a mirror. It shows you who you really are when the pressure is on.
So how do you see it? Are we looking at the start of a massive recovery by February 15th, or is there more pain to come? Drop your thoughts in the comments, and if you haven't subscribed yet, join so you don't miss the next insight. Thanks for listening.
Stay rational out there.